Yes, so as the news is unraveling, I just want to give you guys a very quick update on what is happening right now, because in a short span of, I think, within 1 to 2 weeks, we have several banks in the US collapsing. And I just want to go through what is the impact here and how can we make sure that we are safe as an investor. All right. So let me go through very quickly. Right. So the first few things is this. Number one, I want to talk about exactly what went wrong, okay, for Silicon Valley Bank, right, to go down so quickly, right? And it was right after, right, on the heel of Silvergate Bank as well, okay? And then later on, we're going to talk about another bank, which is Signature Bank, that just a few hours ago, when I was recording this, also collapsed, okay? So this is the latest updated video you want to watch until the end, okay? Secondly is of course how serious is all this problem? Is the whole US banking system in trouble? And how I think the Fed will react, how the market will react. Okay, now let's get straight into it, right? So first and foremost, what happened at the Silicon Valley Bank, right? So it is a typical bank run, right? What is a typical bank run? Basically, the depositors, right? For example, if you put money in the bank, okay, and a lot of us put money in the bank, right? So the bank has all this money, but actually, in essence, does the bank have all this money at any single one point in time? The answer is no, right? So if the depositors withdraw the money faster than the bank can handle, that's where you start to get a bank run, right? So Silicon Valley Bank, or SVB, right, announced that they sold a bunch of securities at a loss. Later we'll talk about these securities, very important. And in order to show up these losses, they will sell 2.25 billion worth of new shares just to get more money. Basically, they are destroying their shares, okay, the value of their shares, just to get more cash. And this triggered a panic in their main customer, which is actually all the key venture capital firms. So remember, right, Silicon Valley Bank is a bank that mainly serves the venture capital world, the tech world, and all these companies started to withdraw money from this bank and causing the bank to have a liquidity issue. That's why they will collapse and the government took over, basically, right? Now, the question is this: what is this security that they bought that, they lost like $2.25 billion? What exactly is this, right? So these securities are actually bonds, a lot of long-dated bonds out there, right? Now, we must remember this is that the formula is the bond prices, okay, is inversely correlated with interest rate. So if the bond prices, interest rate is going up, which is what's happening now, you will see bond prices start to go down, okay? So when rates go up, bond prices go down, then, SVB lost a lot of money and they don't have all this money, right, to pay the depositors. Because last time, what you can do as a bank is, if a lot of people withdraw money from you, you just basically sell away your bonds. But now, all these bonds are in a loss. So when they sell them, they don't even have enough money to pay their depositors. Okay? Now, the thing is this: why does the bank buy all these bonds? It's very important, because it's not that SVB bought all these bonds on its own accord, right? After 2008, the global financial crisis, basically the banks are regulated to own a large amount of high quality liquid asset, or we call it HQLA, right? To make sure that if there's a huge outflow of deposit for 30 days, they are able to sustain it, right? In fact, the coverage is actually more than 100%. That means they must have all these high quality assets to cover more than 100% of all this deposit outflow for 30 days. So what is considered a high quality liquid asset, right? And it's basically your government treasuries, your corporate bonds, etc. Right? These things are generally more stable. And basically the banks bought a lot of these bonds to put on their balance sheet. And guess what? If you buy treasuries back then and the yields went up, right, which is interest rate, then you will lose money. But the question is, so how, right? Aren't the banks supposed to protect themselves against these risks? And they actually do, right? So usually they will employ what we call a hedge, right? To protect any adverse price movement. So how to do the hedge for this case is very simple. It's called an interest rate swap, right? Something that was very reminiscent of the 08, okay? And basically, for example, let's say the bank bought a 10-year treasury and is yielding 4%. Okay, and in order to make sure that if the interest rate were to go up, they are naturally hedged, what they do is they actually go back and sell, okay, a 10-year fixed rate in swap, right? So let's say the difference between the treasury, which is at 4%, and the 10-year yield is at 10-year rate is at 3.5. okay, then they will actually get a little bit of interest here, right? They will make 0.5 because they pay out 3.5, they make 4%. Okay. Now, for those of you who are in the finance world out there, I know I'm super doing this injustice, okay, because I'm very simplifying it, okay. But for the general public, this is exactly how the bank makes sure that they are insured, they are protected from any interest rate jump, right? Because if let's say this 4% jump, right, then this swap will also jump to protect them. Okay. Now, and this will allow the bank to hedge their interest rate risk, right? Should it go up, they will not be so badly affected. Okay. And they will also earn a little spread on their portfolio in this case, which in this example is about 0.5%. So what happened at Silicon Valley Bank, right? It basically, they did not hedge, right? Because overall, their investment portfolio was already more than 50% of their asset. Now, an average US bank is around 24, 25%. So they are 2 times, right, in terms of their investment portfolio that is very exposed. And on top of that, right, over 70% is in what we call MBS, mortgage-backed securities, right? And all these are very sensitive to interest rate. Generally, US banks are maybe about 30% in MBS, right? So, and the problem is when they are so exposed, right, over 50% investment and over 70% of that is in MBS, they did not hedge the interest rate. So basically, they become very greedy. They want to earn all the yields and they don't want to pay any yield, right? So what happens is that every 0.1% move in interest rate, right, caused Silicon Valley Bank to lose more than 650 million. And guess what? Jerome Powell recently, all right, raised the rates a lot over the last 1-2 years, and is going to raise again likely in March. And with a 2% interest rate move, basically SVB will lose more than $13 trillion, basically wiping out the bank's liquid capital. Okay, so while the bank is about 13 billion, not 13 trillion, sorry, 13 billion, my bad here, okay? So while the bank is about $200 billion in assets, but only about 13 billion of that, right, is liquid, or slightly less. So once it's more than that, then the bank is basically bankrupt, okay? Right? So how can Silicon Valley Bank not hedge, right? Aren't the bank all regulated? So this is where it gets interesting, right? Because they are really just the 15th largest bank. What does it mean? That means they have less than 250 billions of assets, right? They have less than 250 billions of assets in their accounts. And with that, they are not subjected to all the tighter regulation scrutiny like the big banks. And that brings us to the next point is that, with all this happening, that's why SVB was doing a lot of shenanigans under their books. Okay, that's why they collapsed. And today, just a few hours ago, we got another bank, Signature Bank, okay, that collapsed. So guys, if you're banking, right, just make sure that your bank is not an S, because we have Silvergate Bank, we have SVB, Silicon Bank, we have Signature Bank. Now, what other banks are S? Okay, so okay, don't sue me. I'm just joking. Okay, but not the name that matters, but how they run the business that matters. Okay, so what happened at Signature Bank? So this is hot off the oven. So number one is a very different story. It's not that they are over leveraged, never hedge or anything. For them, it's a very simple thing. Is that they do most of their businesses with cryptocurrency, with crypto businesses. Okay. And with crypto now very, very bad, very volatile, right? A lot of the businesses are going bankrupt. Silvergate, which is actually the main bank for crypto business, already gone. And they are the second bank after Silvergate. So they are also affected. They are gone. Even though last year, according to the securities filing, right, they had $110 billion in asset. And out of that, actually $8.8 billion is in deposit, quite a lot of those. And so one thing is that actually this story was a bit different from Silvergate. Silvergate is similar, but different from Silicon Valley Bank. Why? Because Silicon Valley Bank, basically, the government came in after they properly declared bankrupt. But this time around, the regulators came in quickly to take over Signature Bank to prevent, right, further crisis, to make sure that this doesn't blow up in their face. Okay, right? So what they have now is an emergency program to backstop the deposits in both banks. Okay, right? Using the Fed Emergency Lending Authority. So basically, they're going to print money. Okay, in short, I'm just going to be very honest here. They're just going to print money to make sure that these people get back their money. Right? How do they do that? Because all the deposits in the US are actually covered by this thing called the FDIC, which you are covered up to $250,000. Okay, but take note for SVB, right, Silicon Valley Bank, more than 95% of their deposit, right, if I'm not wrong, okay, is actually more than 250K. So that means they will not be able to get back the full sum. Okay, I just want to be upfront here. Okay, so while the depositors will get money, right, take note, shareholders, bondholders of both banks are right now what we call being wiped out. That means they will not get any funds because the first priority goes to the depositors. All right. And on top of that, Coinbase also said that they have about 240 millions in cash that is with Signature Bank. Okay, so out of the $240 million, they will get back 250,000. Okay, right? Wow, that's a horrible percentage, man. That's like how many percent is that? Okay, less than 1%. Okay, so now the thing is this. Guys, well, do I think that this thing will spread further? First and foremost, I think no, right? I do not think that this will impact the main banks, right, who are very well diversified, who are not overly exposed, let's say, to crypto or to venture and stuff like that. And if they actually have proper risk management, right, SVB did not hedge their position. That's why they're in so much trouble. Now, if you're a proper bank who hedge your position, you should be fine, okay? And I think this damage currently, as of now, I just want to say, as of now, I could be wrong later on, is mainly limited to the venture capital and crypto world as of this moment. Okay? Now, let me just share the most important thing is, what am I doing? Now, first and foremost, how will the market react? I think the market will react quite violently in the next few days. I think there'll be good opportunities in the market, especially banking sector, right? If you have very good banks, very solid banks, in my opinion, I think Singapore banks in general are quite well diversified. They are also quite safe, right? This is not a stock recommendation, of course. I'm buying it for myself, okay, right? But on top of just investing in banks where they're in distress, right? How do you protect yourself against all this, right? You can see that if you have money with Signature Bank, Silicon Valley Bank, right, you'll be in a lot of pain right now. So what am I doing? Okay, so first and foremost, right, is that I would want to stay away with the small-ish bank. Okay, anything less than $250 billion in asset to me is small, right? So if you want to put a lot of your savings with a bank, make sure you're with one of the major banks. And I want to state up front, don't put with investment bank. Okay, put with what we call your retail banks, your deposit banks. That means they are just collecting deposits, then they just lend it out properly, and then they get interest. Okay, these banks are, I would say, generally safer. So that's what I will do. Okay, that's what I will do. Secondly is banks, they are bigger than 250 billion, right? Under the US regulations. I don't know, is it called regulations or constitution or what, right? Is that they are likely to be bailed out because they are too big to fail. If they fail, the impact is too great. So the Federal Reserve will go all out to make sure they don't die. But the smaller banks are actually not guaranteed to be safe. So just take note of that. Next one. FDIC only covers 250K, right? Guess what? In Singapore, we also have something similar called the SDIC. It covers even lesser, right? Only 75,000 Sing dollars. So it really, if you put your money with the bank, while now is very good interest, but essentially, is it very safe? I would say, if something happens, shit hit the fans, right? Per account, you're only getting $75,000. So think for yourself, right? So what I do is, for now, on the cryptocurrency end, I'm staying away from the crypto exchanges for a while, right? Even though I want to buy or sell, I usually use exchanges, but now I'm just staying away. Stay away from Coinbase, stay away from Binance. I'm just like going to Cold Wallet. I keep all my Bitcoin, Ethereum in Cold Wallet. Okay? And one thing you know is that, whatever has stood the test of time is something that I like to invest. For example, Bitcoin and Ethereum has stood the test of time. The other smaller currencies, NFT, all this, right? To be honest, is more of a speculation. It's more for trading, but not for investing. Okay. And also, and this is why, right? Other than buying government bonds, right, which is not stocked with the bank, is stocked in my own name, right, in my own account. Most of my other assets, right, I want to invest them in hard assets that cannot run away from me. For example, in properties, right, good ones, of course, right, both in Singapore. I have Singapore properties, I have UK properties. And I also are buying a bit more precious metals right now in terms of gold, right? So, guys, just take note that in this environment, right, everything can be quite uncertain. If you're putting your money with the banks, then you need to know that while you're maybe getting a big good interest, but the risk is there, right? Now, I don't think that this contagion will really spread all the way to Asia, right? Because these are quite small banks, unless we start to see big banks in the US start collapsing, like Wells Fargo and JP Morgan and stuff like that, right? But, right, ultimately ask yourself is, do you want to even have that risk? Okay, so if you don't want to have that risk, then personally what I do is I keep some money that I need, right? Maybe a few $100,000 here and there, but otherwise the rest of my assets are basically invested in hard assets, right? Properties, gold. To me, stock market is a hard asset because my shares are actually held, right, in my name. Okay, so the bank cannot collapse and run away from me. All right. So, guys, this is all I want to share with you. I hope you all learn a lot from this experience. Right now, what do you think the situation? Do you think it's going to get worse? Put in the comments below. Let me know. And if you have any questions, furthermore, put in the comments as well. And for those of you who previously missed my UK property sharing, right, regarding social housing, right, I'm just going to put a link down below. You can go and watch it. This is one of the few reasons why I invest in property as well, because it is really, to me, the real backstop, right? SDIC is not going to save me, but my property is always going to be there, right? Even if the bank collapse, right? Even better, then my loan is gone, right? I don't know, okay? But no matter what, the property is there, my value is always protected, and therefore I can sleep soundly at night. Okay, so once again, my heart goes out to all of you who are affected by this incident, especially for those of you who are in the States. I really feel for you guys, and I just hope you guys are good, right? Hope you guys bounce back from this and get stronger. Okay, so that's all I have to share with you guys. I'm going to put all the links to my UK property, to my other things that I shared before that is good for this situation, right? Put in the links below. And yeah, and I'll see you guys next time. Bye bye.